Hey everyone, and welcome back to the Safe, Simple, Sound podcast, Tax Edition. Sam here, your guide to making sense of money matters. We believe that getting a grip on your finances, really seizing financial control, starts with understanding the fundamentals. One fundamental that trips up a lot of people is the standard deduction. Today, we're diving deep into understanding the standard deduction. Our discussion is based on a really helpful guide that simplifies information drawn directly from the official IRS Tax Guide, Publication 17. It's designed to be a simple guide to standard deduction concepts. This guide really highlights a few key things. First, how the standard deduction acts as a major tool for simplifying tax deductions and helping potentially lower taxes for millions of Americans. Second, that the crucial decision often comes down to standard deduction versus itemized, knowing which path benefits you most. And third, that the standard deduction amount isn't static. It varies significantly based on your filing status and other factors. The amounts are adjusted for inflation and change every year. Getting this right is a key part of understanding financial choices and making sure your tax filing strategy is truly safe, simple, and sound. So whether you're filing for the first time or just need a refresher, stick around. Let's demystify the standard deduction together. One term you'll hear constantly, and one of the first big concepts to grasp when it comes to taxes, is the standard deduction. So what is the standard deduction anyway? Let's break it down. Essentially, the standard deduction is a specific fixed dollar amount that the IRS, that's the Internal Revenue Service, allows most taxpayers to subtract directly from their income before calculating how much tax they actually owe. Think of it as a baseline benefit. This number effectively reduces your taxable income, which is the amount your tax rate is actually applied to. It's a key way the system helps simplify tax deductions for millions and millions of people every single year. Now, why does the IRS even offer this? Why not make everyone track every single possible expense? Think about it. Tracking every single potential deduction, every medical bill, every small charitable donation, every bit of state tax paid, that would be incredibly complex and time-consuming for the average person, right? The standard deduction exists precisely to simplify things. It provides a guaranteed deduction amount without needing a shoebox full of receipts for everything. Its purpose is really twofold: make tax filing easier for a huge chunk of the population, and, importantly, help lower taxes by reducing that taxable income right off the bat. I often think of it like ordering a combo meal instead of picking every single side dish a la carte. The combo meal is straightforward, easy to order, and gives you a good baseline value. Going a la carte might get you exactly what you want, or maybe even more value if you have specific significant needs, but it takes more effort and decision-making. So, who gets this combo meal? The good news is most taxpayers qualify to take the standard deduction. It's the default choice for many individuals and families because it's often the most straightforward and sometimes the most beneficial option, especially if your financial life isn't overly complex. But, and this is important, it's not for everyone. There are specific standard deduction rules about who cannot claim it. Knowing these exceptions is really crucial to avoid making a mistake on your return. The main ones to be aware of are: 1. If you're using the married filing separately status and your spouse chooses to itemize their deductions on their return, then you cannot take the standard deduction. You'd have to itemize too, even if your itemized total is 0. 2. If you're filing a tax return for what's called a short tax year, maybe because you changed your accounting period. This is less common for individuals, but it's an exception. 3. And finally, certain non-resident aliens and dual-status aliens generally cannot claim the standard deduction unless they meet specific criteria to be treated as a U.S. resident for tax purposes. It really makes you think, doesn't it? Why do you think the IRS offers a simplified option like the standard deduction instead of requiring everyone to track every possible expense? And how does knowing these exceptions who cannot claim it actually help you avoid potential tax filing errors down the road? Just being aware of these rules can save you a headache later. Beyond simplifying things, what's the main benefit the standard deduction offers to the average taxpayer? It boils down to reducing that taxable income and consequently helping to lower taxes. So, To quickly recap this segment, the standard deduction is a fixed amount set by the IRS to simplify tax deductions and reduce your taxable income. Most people can take it, but there are key exceptions. The standard deduction rules you need to be aware of, especially regarding your filing status and whether your spouse itemizes if you file separately. Okay, here's your quick action item for this segment. Take a moment today to clearly identify your filing status. Are you single, married, filing jointly, head of household, etc.? Then, quickly review those main exceptions we talked about. Married filing separately with an itemizing spouse, short tax year, or specific residency statuses. Just make sure none of them apply to your situation for this tax year before assuming you can take the standard deduction. Knowing if you can take the standard deduction is step one. Next up, we'll dive into the exciting part, how much that deduction actually is for different people and different situations, including the specific standard deduction 2024 amounts and some special rules that might apply to you. Now let's move into segment 2, finding your number, focusing on the standard deduction amounts and some special rules you need to know. Because knowing the concept is great, but knowing your number is where it really starts to matter for your tax return. So, the absolute biggest factor determining your basic standard deduction amount, it's your filing status. Think of it like picking the right size shirt. Single, married, head of household. Each has a different fit, or in this case, a different deduction amount. Let's talk concrete numbers for the standard deduction 2024 tax year. That's the return you'll file in early 2025. Keep these figures in mind. If your filing status is single or married, filing separately, your basic standard deduction 2024 is $14,600. If you're married, filing jointly, or a qualifying surviving spouse, that number doubles to $29,200. And if you file as head of household, your amount is $21,900. Remember, these are specifically the standard deduction 2024 figures. We'll touch on why the year matters in a moment. Now, just looking at those numbers, $14,600 for single, $29,200 for married filing jointly, $21,900 for head of household, what does that suggest? How does the tax code seem to treat different household structures through the standard deduction? It seems to acknowledge the potentially higher costs or different economic units of couples and single parents, right? Something to ponder. Okay, beyond the basics, there are some special rules. The first big one affects dependents. If someone, like your parents, can claim you as a dependent on their tax return, your own standard deduction is limited. It's not automatically that $14,600 single amount. Instead, for 2024, a dependent's standard deduction is generally the greater of two options. 1, $1,300. 2, your total earned income for the year plus $450. But, and this is key, it can't be more than the regular standard deduction for your filing status. So if you're a single dependent, it's capped at that standard deduction, single 2024 amount of $14,600. Think about a teenager with a summer job who earned $4,000. Their earned income plus $450 is $4,450. Since that's greater than $1,300, their standard deduction would be $4,450. If they only had interest income and no job, their deduction would just be $1,300. Why is it so important for dependents, and often their parents, to get this calculation right? Well, it directly impacts whether that dependent owes any tax on their earnings and prevents a potential double dipping of tax benefits. Understanding this helps manage expectations, especially when kids start earning their first paychecks. All right, another important set of special rules applies if you are age 65 or older, or if you are legally blind. The IRS provides an extra standard deduction for over 65 and has specific standard deduction rules for blind taxpayers. Essentially, you get to add an additional amount on top of your regular standard deduction amount. The exact extra amount depends on your filing status and whether one or both spouses meet the age or blindness criteria. You don't need to memorize the extra amounts right now. Just know that if this applies to you, your standard deduction will be higher than the base figures we listed earlier. The official details and amounts are in IRS tables, like Table 10s 2 you can find in Publication 17, the General Tax Guide. Think about how your own standard deduction might shift over a lifetime. You might start as a dependent with a limited deduction, then file single with the base amount, perhaps get married and use the joint amount, and eventually qualify for the extra standard deduction for over 65. It's interesting how the rules adapt to different life stages, isn't it? And finally, a crucial reminder, these standard deduction amounts aren't static. The IRS adjusts them pretty much every year for inflation. That's why I keep emphasizing Standard Deduction 2024. When you sit down to do your taxes in 2025, make sure you're looking at the 2024 figures. Using last year's numbers by mistake could lead to errors. Okay, let's quickly recap segment 2. Your primary standard deduction amount hinges on your filing status. We covered the key standard deduction 2024 amounts: $14,600 for single MFS, $29,200 for MFJ QSS, and $21,900 for head of household. There are special limited deduction rules for dependents. There's an extra standard deduction for over 65 and specific standard deduction rules for blind taxpayers, increasing their total deduction. And remember, these amounts change annually, so always use the current year's figures. So here's your action item for this segment. Take a moment after this to look up the specific standard deduction 2024 amount that corresponds to your filing status. And if you think you might be claimed as a dependent, or if you are over 65 or blind, dig just a little deeper to see how those special rules might adjust your number. Knowing your number is the first step to making smart tax decisions. All right, now that you've got a handle on finding your potential standard deduction amount, the next logical question is it the best option for you? Or could you potentially save more money by listing out specific expenses, a process called itemizing? That leads us perfectly into our next segment. Stick around. Now we arrive at the big crossroads, the decision point that trips up a lot of people when they sit down to do their taxes. It's segment 3, and we're tackling the big choice, standard deduction versus itemizing. So let's recap the core decision you need to make here. Should I take the standard deduction or itemize? It sounds complicated, but honestly, there's a really straightforward golden rule to guide you. Think of it like choosing the best coupon at the grocery store checkout. You want the one that saves you the most money, right? Same idea here. The golden rule is choose whichever deduction is larger. Compare the standard deduction amount the IRS gives you for your filing status against the total dollar amount of all your allowable itemized deductions. Whichever number is higher is the one you should generally take, because that higher deduction lowers your taxable income more, leading to maximum tax savings. Simple as that. Okay, so when might itemizing deductions actually win out? When would your specific expenses add up to more than that standard amount? Well, this usually happens if you have significant costs in certain areas. We're talking about things like large uninsured medical or dental expenses, paying home mortgage interest and property taxes, making substantial donations to qualified charities, or maybe you had significant uninsured losses from things like theft or a casualty event. The IRS spells these out in detail, particularly in Chapters 11 and 12 of Publication 17, if you ever need the specifics. Now, a really key factor here, especially for homeowners, is that state and local tax deduction, often called the SALT deduction. There's currently a cap on it. You can only deduct up to $10,000 per household for state and local income taxes or sales taxes plus property taxes all combined. Because of this cap, many people who used to benefit from itemizing because of high property taxes now find the standard deduction is actually higher for them. Let's paint a picture with numbers, because that always helps me. Imagine you're filing as single. For 2024, your standard deduction is $14,600. Now let's say you gather all your potential itemized deductions, maybe a bit of mortgage interest, your property taxes, and some charitable giving, and the grand total comes to $11,000. Comparing the two, $14,600 is clearly bigger than $11,000. So you'd take the standard deduction. Easy. But what if, in another scenario, maybe you had higher medical costs or made larger donations and your potential itemized deductions added up to $16,000? Well, now $16,000 beats $14,600. In this case, you'd want to itemize deductions to get that bigger benefit and lower taxes. It really makes you think, doesn't it? What kind of life events might suddenly flip the switch for you? Maybe buying your first home, even with the SALT cap, pushes you over the edge. Or perhaps facing significant unexpected medical bills one year makes itemizing suddenly beneficial. It's very personal. And think about the record keeping too. Itemizing deductions requires proof, receipts, statements, careful tracking. Sometimes, even if itemizing might save you a few extra dollars, the simplicity of just taking the standard deduction might feel worth it for the time and hassle saved. That's a judgment call, but mathematically, the higher deduction is always better for tax savings. It's also true that because the standard deduction amounts have increased significantly in recent years, far fewer taxpayers actually need to itemize deductions now compared to the past. The standard option simply covers more ground for more people. So, the final thought, the big takeaway here is always compare. Don't just assume the standard deduction is right for you or that itemizing is definitely better because you own a home. Take a few minutes, gather your potential numbers, and actually calculate both ways if you're anywhere near the threshold. Doing that quick check is crucial to effectively lower taxes and is a key part of understanding the standard deduction's real value to you. Which leads perfectly into your call to action for this segment. I want you to actually do that comparison, even if it's just a quick estimate. Gather your potential itemized deduction records. Pull out that mortgage interest statement. Find your property tax bills. Look up your charitable donation receipts. Add up what you might be able to deduct. Then, compare that total directly against your specific standard deduction amount, 2024. That comparison is the absolute key. Is your itemized total higher or lower? Now you know. All right, folks, that brings us to the end of our deep dive into understanding the standard deduction. We covered quite a bit today, starting with the basics, really defining what the standard deduction is and why the IRS offers this simplified route, all based on that helpful guide summarizing Publication 17. We then moved into the specifics, looking at the standard deduction 2024 amounts based on your filing status. Whether you're dealing with the standard deduction single 2024, standard deduction married filing jointly 2024, or standard deduction head of household 2024. We also touched on those important special circumstances like the standard deduction for dependents and the extra standard deduction for over 65, or the standard deduction rules for blind taxpayers. And perhaps most importantly, we tackled Segment 3, the big choice, standard deduction versus itemizing. Remember that golden rule. Compare your potential itemized deductions total against your specific standard deduction amount 2024. Knowing should I take the standard deduction or itemize is crucial for potentially lowering your taxable income and figuring out how to lower taxes effectively for your situation. That comparison step is often where people can make the biggest impact. Ultimately, this is all about making tax deductions less confusing, offering you a simple guide to standard deduction principles so you feel more confident during tax season. It's a key part of seizing financial control. Thank you so much for tuning in to the Safe, Simple, Sound podcast today. I really appreciate you spending your time with us. If you found this episode helpful, please check out our show notes. We'll link to resources like IRS Publication 17 there. Consider leaving us a review on your favorite podcast platform. Share this episode with someone who might be wrestling with their taxes, and definitely hit subscribe so you don't miss what's coming up next. We'll be back soon, tackling another topic to help you make those essential understanding financial choices moments clearer. Until then, this is Sam, reminding you to keep seeking clarity and making those safe, simple, and sound financial decisions. Catch you next time.